Hello everybody, welcome to Talk About Houses. I'm Todd.
I'm Juana.
Today's video is titled Why the Housing Market is Not Likely to Crash Anytime Soon. So what we did is we went and pulled some data from Fannie Mae and Freddie Mac. And one of the interesting thing Freddie Mac tracks is how long people stay in their houses. Now this is critical information, right?
Right. So when we're looking at this, we see that back in 2007, right around the crash of real estate, we saw that people were staying in their homes about 5 years.
Okay.
But now people are staying in their homes 10.6 years. That's more than twice the amount of time. And that's happening for a lot of reasons. As you know, we like to put kind of context to numbers. So let's look at why people are staying in their homes. So we've got people like baby boomers. Instead of them downsizing, retiring, whatever, they are healthy, they're living longer, they're working longer, and then they are providing housing for multiple generations. So maybe they're taking care of elderly family members. Maybe there are younger family members in their 20s or 30s that are living with them. So instead of getting rid of the big family house, they're keeping it. So when they're keeping it, these are homes that should have come on the market and didn't.
Okay, so let's put this in perspective. I'm going to give you guys a chart to look at. Okay, so here's the chart. Now, there's three things on this chart. You have these blue bars, and what the blue bars represent is the number of years on average people stay in their homes. And this is the one Juana was talking about. If you look all the way to the right, it says 10.6. And if you look back to the left, it's at about 10, maybe 10.1. But that was a year ago. So in the last, say, year and a half, people on average are spending another 5 months in their home. Well, like Juana said, in 2007, they were only spending 5 years in their house, and they were selling it, moving on to their house. The other two lines, the gold-looking line is the potential home sales. Okay, that's the potential home sales, and then the green line is the house buying power, and what that's based on is incomes, interest rates, and all these other things. And you can see that we have this disequilibrium because we have a greater home buying power than potential home sales. So there's there's three things on this chart. So it is kind of confusing, but if you look to the left, the numbers on the left are indexes for the two lines. And then the numbers on the right are the indexes for the bars that go across. The reason why these are together is because they're showing two different things sort of superimposed. What this says is very simple. We have this high ability to buy houses. We have this lower potential number of homes on the market, and that doesn't look, we've been in disequilibrium for about 18 months. But what's really interesting is these blue bars, this trend, okay? That's very interesting. Now, we're going to talk about a couple pieces of just generic information, okay? The boomers and the people that were older than the boomers, basically their parents or people who were young when the boomers were born, are behaving differently than previous generations behaved.
Right.
And that is causing a problem now. So what's the problem? Why is this causing a problem? Like, what are they doing differently now than they didn't do, 20 years ago? Right.
So, retirement ages are changing. They're getting older. So for example, let's take people used to retire sometime between 55 and 60, then it went to 60 to 65. Now people are working longer than that, and we're seeing it across professions.
Okay.
We're even seeing it with pilots. Pilots used to have to retire at 60, now it's 65. So because we're healthier, we're living longer, we are, in essence, keeping these homes longer. So this is causing a shortage of homes on the market, because remember, the primary source of homes on the market is actually resale homes. So when people are not turning homes, then that's keeping resale homes from coming on the market.
Yeah, so here's the bottom line. Previous generations labored a great deal. And then as they got older, they couldn't do the labor. So they retired. And they typically, the residents that they lived in, that they raised children in, it was usually a bigger house, they would sell it and then move into a smaller house. And they would take whatever money they could get out of the house, and then whatever Social Security or any type of pension funds, and that's what they would live off of, okay? Now, they had to do that. In some cases, they had to sell their big home and then move into a smaller home, but they don't have to do that now for two reasons, right? One is a lot of them are still working, and they're still working is because the labor has shifted from physical labor to intellectual labor. So these people have more jobs that require less physical labor. They're doing more online type work or consulting type work or whatever. And because they're still working, they're not interested in moving. And they don't need the money, okay? And many of them have saved and they have, still have good incomes. So those little houses that they were moving into, the smaller houses, have been bought up by investors. So the normal housing churn is they would sell their house, buy the little house, and then you guys out there would go buy their house. The problem is their house isn't available because they're living in it. Now, there's an interesting thing that Freddie Mac did in this study. I'm going to read it to you because it's in a quotation mark, so I don't want to get it wrong. It said that if seniors and adults born between 1931 and 1959 behaved like earlier generations, they would have released 1.6 million additional housing units to the market by 2018. As seniors continue to choose to age in place, there will be fewer existing homes available for sale. So you can talk about all the things causing the housing market to be messed up, but seniors aging in place is really a huge factor that nobody's talking about because it's a phenomenon that's pretty new.
It is really new. And one of the things that everybody loves to do is they love to blame their parents for everything. There you go. You have permission to blame your parents for this too.
And then we have another interesting thing. We have people aging in place, and then we have the largest group of first-time home buyers, the millennials and Gen Zs, with incomes and a ton of savings trying to buy a house, and they can't buy a house because the houses aren't turning. It is unlikely that the housing market is going to suffer a decline as long as people are not churning these homes. And if we end up like Europe, right, or places where people get a house and they live in it their whole life, it's just going to continue. This problem is going to continue.
Exactly. So between the millennials chasing homes because they've got money and interest rates are low, and the baby boomers not bringing homes to market, this definitely speaks of a market that is not going to change or decline anytime soon.
Yeah. We've talked about this before. We're going to track this. We're going to look for the signal, try to find the real meaning here. We are not seeing any major, and I know the one thing everyone says is, well, what about when the moratorium is lifted? That's what's going to happen. And I'm going to tell you a story. As many of you know, Juana and I, back during the last bust of the housing market, we sold a couple thousand, 3,000 bank-owned homes is the listing agent. And we probably about 2/3 of the way through that, we could start to see the number of incoming assignments from the banks and asset management companies were declining. So we were told there was going to be a tsunami. That was the word used, a tsunami of properties were going to flood the market. This was in about 2009 or 10. They were going to flood the market. The first wave of properties, that was the first wave, but we were going to see the second wave that was going to flood the market. And guess what?
Never showed up.
It never showed up. And that's the reason why when whatever moratoriums are out their end, you're not going to see a flood of properties, because the banks have figured out that you can't do that, because if you do that, you crush the housing market. People can't get loans, and they can't get mortgages, and the banks are basically cutting their own throats, right?
There are other stabilizing pillars in place today that were not in place back then.
Okay, let's talk about equity. In 2006, how much equity did the average person have in their house?
Not a whole lot, because they were buying homes with zero down or even 125% mortgage loans, which means that they were borrowing more than the home was worth to begin with. So that and then borrowing was really easy. They had what in the industry we called liar loans, because you just stated how much you made and you didn't have to prove it. So lending practices were completely different than they are now. Lending practices have tightened up a whole lot. And also remember that during the economic downturn, there were probably half the properties out there were purchased cash, which again is a very stabilizing force, because without a mortgage, those homes are very stable because they're 100% equity. So we've got that going on. We've got appreciation over the last 15 years or so that's taken place as well. So again, all that equity. So there are a lot of pieces that are different. Plus, let's not forget our favorite things to pick on, all the institutional investors that have been purchasing homes.
Yep.
Again, they are a very stabilizing force in the market. So we have a whole bunch of pillars that we simply did not have before. We didn't have people with equity in their homes. We didn't have institutional investors in the game. So there are a whole lot of different things going on now that were not going on back then.
Yeah, I would say in 2022, not to expect a housing crash. Another interesting phenomenon is that the investors who bought all those houses for $50,000 that are now, the house is worth $200,000, let's say, in Las Vegas is a good example. They're not selling. And the reason they're not selling is because what else are they going to do with that cash? They have steady income. The house is, remember, they probably paid cash for the house. They have the steady income stream that comes in. And if they sell the house, they're going to have this capital gain, and tax rates are probably just going up. Mm-hmm. So they don't want to get a lot of people don't want to get stuck with taking an appreciating asset that's producing income, getting rid of it, and then paying a huge tax on it. So tax policy matters in this effect. So you have multiple things that exist now that didn't exist back then. So you could say that the lending institution, you had a perfect storm in 2005 and 6 for the market. It was the kindling that would cause it to explode and have a raging fire. But those things are not only they're all gone, they're on the opposite side of the spectrum. They're actually very safe. If you look at how home prices, you go in any market, look at what home prices have done since probably 2010 or 11. Then you'll probably see this nice, steady climb up. Mm-hmm. And all of a sudden, what we realize is that we've probably, everyone who bought a last home in the last 10 years, congratulations, you won the lottery, okay? And so, but this new data that's out by Freddie Mac showing that people are spending 10.6 years, and that trend that we showed you, I'm going to put it up again so you can see it. Okay, it's coming up one more time. That trend of people staying long, that's going to, probably in 5 more years, people will be staying in their houses 12 or 13 years. And that when that happens, you're not going to see the housing market, until those people start dying. Those people are not leaving those homes, and you're not going to see more inventory come into the market for people to buy. So I predict this is going to steadily increase. We're going to see prices keep going up. We're going to see fewer homes on the market, just like we have been. I think this is sort of, you could say, the new normal. I said we didn't like, in a video about 3 or 4 months ago, I said I don't like that term, but that's what it is.
It is. It's simply the development that has a lot of different components to it. So we're looking at all the social factors, the economic factors, what's going on with builders. Everything kind of has collided to get us to this point.
And there's also been a underbuilding of homes for the last decade. Mm-hmm. The country's growing, people are still coming here, population's still increasing, building isn't keeping up, and housing is an asset class. You do have a limit because you can't just create, think about it. If you took the top 100 metropolitan cities in the US mm-hmm. 15 years ago, mm-hmm. I think the number one would be like New York City. Mm-hmm. Okay, that would be the biggest one. Number 100 would probably be a city like Spokane, Washington. Okay, mm-hmm. Now in the last 15 years, have any brand new cities that didn't exist popped up and popped into the top 100? Well, the answer is no. No one's just gone and created a new city. So we have to rely on existing cities. Well, existing cities have limits to growth. They have geographical limits, and then they have functional limits because you can only put, so many, sewer lines out there. You can only have so much, infrastructure, and you start running into hurdles. And what we're seeing is that, throughout the U.S., unless we start creating new places to live or some other things potentially these VTOL airplanes, they could be a game changer. We'll do a whole nother video on that. These little small airplanes that can take you, 100 miles in a short period of time, really cheaply. That could be a game changer. Until any of that happens, I think we're going to continue to see this for a long time. And I think other people are seeing this. Institutional people are seeing this, and they're buying the houses.
Yes.
And they're going to hold on for dear life. That's what I predict.
Sounds good.
Okay. If you enjoyed the video, it's a very long video. Please subscribe, hit the notification bell. What else?
Like the video, share it, and we'll see you on the next video. Bye.
Bye.